Welcome to the KPC Smart Money Podcast with Kevin and Karen Chris. So today, we sometimes we do financial stuff. Sometimes, like last week, we did that you should take a vacation. It could save your life. But this week, we're going to talk about something financial. Should you hold or fold a poor performing fund? Do you have a mutual fund in your portfolio that isn't doing so well, but you're not quite sure whether it's time to throw in the towel on it? Man, I tell you what, I have that conversation almost every day
yes.
with clients. Well, it might be tempting to dump your poor performance. It's important to know when to hold them and when to fold them.
Doesn't that make you think of the song?
When to hold them.
Yes,
and when
the gambler.
To fold 'em. Kenny Rogers.
Yep.
Here are some questions you may want to consider first.
Yeah, where does this fund fit into your overall asset allocation strategy? Again, asset allocation simply means how is your money divided between major asset classes like stocks, also called equities, bonds, cash, and it's the biggest factor in how your portfolio performs. The general idea is to have more money in conservative asset classes like bonds and cash. The sooner you need the money and the more uncomfortable you are with risk. That we see that as people are approaching retirement, they're new into retirement. And conversely, the longer you have until you need the money and the more comfortable you are with risk, the more you can have in aggressive investments, more like stocks. And if you're not sure what your allocation strategy is, when you get a statement, look at your pie chart, little pie charts on your statements. That's going to tell you what your asset allocations are. So let's just say you're planning to use the money to buy a home in the next couple of years. If that is the case, you probably don't want to be taking a lot of risk. So having that money invested in something relatively aggressive, like an equity mutual fund, probably wouldn't be appropriate no matter how well the fund's performing. After all, tech stocks were performing great right up to the bubble burst in 2000. And we all know what happened to real estate in 2006. And we know what happened to financial stocks in 2008.
So,
crash and burn.
Instead of chasing past performance, you want to examine how risky the investment is and whether it's appropriate for your goals and risk tolerance. Even if you're investing for a long-term goal and you're comfortable with the ups and downs of the market, you still have to think about how the fund complements what you already have. You know what makes me think as we're talking about this? Get an advisor.
Mm-hmm.
If you're not sure exactly where you should be and what you should be doing, if you have a good advisor, many of us have tools that can help you and explain to you why things are the way that they are. But the main thing is to not make, we talked about this a couple of weeks ago, to not make stressful, rash decisions.
Knee-jerk reactions.
Yeah, knee-jerk reactions. So, for example, if the entire equity portion of your portfolio is in domestic stocks, an international fund could diversify it a lot more than another domestic fund would. Likewise, check to see that you have a balance of large cap versus small cap stocks, growth versus value stocks, and short-term versus long-term bonds.
And I'm just going to throw in here, too, what a lot of advisors don't talk about. Diversification has to do with all of your assets. So we often recommend that you might want to have a portion of your asset allocation outside of the stock market itself.
That's good.
But keep in mind that just as every dog has his day, each of these asset classes will have its own cycles. So unfortunately, no one's really figured out a way to reliably predict these cycles. But by spreading your money around, you can try and make sure that you participate in whatever asset class is doing well at the time. And those funds appreciate in value. As they do, they may exceed your asset allocation targets, and then you're going to need to rebalance your portfolio. Kevin, why don't you explain a little bit about what rebalancing is?
Well, look, every 90 days, at least with our clients, and every 90 days there's rebalancing going on. And that means if you're getting overweighted in equities, like during the last 12 years, we've mostly been in one of the longest bull markets we've ever been in.
Mm-hmm.
So let's just say what we're saying here, that if you're in 60% stock and 40% bonds, and your stocks are doing really, really well, and your bonds are just kind of doing what bonds do, fixed income, right?
Mm-hmm.
Making a percentage return that doesn't really go up or down very much, right? So all of a sudden you're in 70% stocks and 30% bonds because, well,
Stocks
you need to
grew faster, grew more.
yeah, so you need to rebalance that to keep to your personal profile, your risk profile.
Your allocation. Mm-hmm.
Yeah, so that's pretty much it. So, you know, I think a lot of it is too, Karen, is that you have to be careful in what your needs are for your expenses too. It's not all about your appetite for risk. Some people have a huge appetite for risk and they shouldn't be taking it. And some people are more conservative, but they could afford to take more risk. These are kind of conversations you should have with an advisor. You might be more of a 50-50 type equities to fixed income person, but you have pensions and your house is paid off and you're frugal, so your expenses aren't high, your debt is low. You could afford to take more chances if you wanted to.
If you wanted to, that
And so those are conversations you really need to have with an advisor.
Well, and Kevin, another thing to consider is how much is the fund costing you? Once you know where a fund fits in your asset allocation, you should at least compare its performance to other funds in the asset class. Well, you know what? That's the logic, but in fact, past performance is a pretty weak indicator of future long-term performance, even when comparing similar funds to each other. One study found an inverse relationship between the length of time and the ability of top-performing funds to maintain their success. So we're going to throw out what might be a better indicator of future performance.
Okay, so what is a better indicator of future performance? It turns out that funds with low fees and low turnover tend to have stronger future performance than funds with higher fees and turnover. Let me repeat that. Okay, so you might not understand what's being said there. It turns out that funds with low fees, okay, that's usually mutual funds that have been around for a longer time, or exchange traded funds or index funds, and low turnover. That means there's not a lot of changes going on inside the fund, right? A lot of they tend to have stronger future performance than funds with high fees and turnover. So that if you're a do-it-yourselfer, that's something that you can look for. When it comes to mutual fund fees, people generally think of loads or the commissions that are charged to compensate brokers who sell you a loaded fund. However, there are also annual fees of typically around 1% called the expense ratio that practically all funds charge to cover administrative, management and marketing expenses. Morningstar has called a low expense ratio the most proven predictor of future fund returns. We call fintech a software that can tell you what those fees are, right?
Yes.
So in addition, high turnover or frequent buying and selling of individual securities cause the funds to incur additional trading costs. These were estimated to cost the average U.S. stock fund another 1.44%. That could be a total of almost 2.5% a year of lost returns from fund expenses and trading costs.
Yeah.
The moral of the story is that you may want to dump your overpriced, high turnover funds regardless of how well they've been performing for you. That performance may not last, but the cost likely will. Instead, consider funds with low cost and low turnover to implement your asset allocation strategy.
And you like ETFs.
Yeah, and there's some mutual funds that have lower cost. Well, even I bought a mutual fund for you that has pretty high fees, but it has a long track record of good performance and great dividends.
Yeah.
So it's not usually the ones with lower fees are going to perform better, but you have to take each one, at face value.
Yes.
And you have to do the study. And, you and I mean, we just went to a luncheon with a company that does real estate funds.
Yeah, because we want to investigate. We want to see the opportunities. Yes.
Exactly. Because we have our own portfolios that we buy stuff for ourselves. So it's important that sometimes you get second opinions, you do some research, find an advisor that you can trust. So could selling this fund save you some money in taxes? Maybe. So look, we're out of time. We'll be back with another topic next year. Next week. So anyway, you're listening to Kevin and Karen. God bless you until next week. We'll be back with a new topic.
You've been listening to the KPC Smart Money Podcast with Kevin and Karen Christ. To listen to more episodes, visit kpcsmartmoney.com. You can also find the KPC Smart Money Podcast on Apple Podcasts, Google Play, Spotify, and Stitcher.
KPC Financial Solutions is an independent financial services firm that utilizes a variety of investment and insurance products. Investment advisory services offered only by duly registered individuals through KPC Financial Solutions, LLC, a registered investment company. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying ability of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should be construed as advice designed to meet the particular needs of an individual's situation. KPC Financial Solutions is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by KPC Financial Solutions. Hypothetical examples have been provided for illustrative purposes only. It does not represent a real-life scenario and should not be construed as advice designed to meet the particular needs of an individual's situation.